Good afternoon, everyone. Thank you so much for dialing in our Phillip Roundtable, March 2024. My name is Kim, and I'm happy to be your host for today's discussion. As we move from spring to summer, global markets have seen a significant rally, notably led by Japan, with the US and Taiwan also reaching record highs. The question arises, will this trend persist? On a different note, challenges persist for China and Hong Kong markets and selected ASEAN markets like Singapore and Thailand. Is the worst behind us? Today, we are honored to have two speakers with us. Mr. Edwin Ho Chun Wei from Aiman Asset Management Sdn Bhd and Puan Nazifa binti Muhammad Ashad, the head of equity investment from BIMB Investment Management Bhd. Allow me to introduce our speakers today. Mr. Evan Hall, the portfolio manager of Aiman Asset Management Sdn Bhd, the wholly owned Sharia compliant subsidiary of Aham Capital, formerly known as Affin Hwang Asset Management Bhd. His current designation sees him actively managing funds in the Asia Pacific ex-Japan region. Evan has been with Aiman for 5 years and is the key person in charge of investment decisions and research coverage of the India and Indonesia equity markets. Prior to joining Aiman, he began his career in Public Mutual Berhad, where he covered the Indonesia equity market for 7 years. Evan graduated with a Bachelor of Accounting honors degree from the University of Malaya and is also a chartered financial analyst. Our second speaker for today is Puan Nazifa. She's the head of equity investment, BIMB Investment Management Berhad. She joined the firm on 8 December 2023. She's a highly accomplished professional with more than 18 years of cumulative experience in the financial and investment industries, specializing in equity and research analysis for both local and foreign equities. Her career is marked by a diverse range of competencies, including managing private mandates, ETFs, ESG investments, unit trusts, and proprietary investments with cumulative asset under management exceeding 7 billion ringgit. Prior to joining BIMB Investment, Puan Nazifa held the position of Senior Fund Manager of MIDF Asset Management Berhad. Her extensive career has encompassed positions at esteemed institutions such as ValueCap Sdn Bhd, Permodalan BSM Berhad, Syarikat Takaful Malaysia Berhad, and Sime Nabi Berhad. Puan Nazifa holds a Bachelor of Science with Honours in Actuarial Science from University Technology Mara and a CMSRL license. Let's move on to the first question. Probably we can start with Edwin, then to Nazifa. The US market has experienced 5 consecutive months of gains, largely driven by a surge in the Magnificent Seven stocks. However, this rally appears uneven as other names such as Apple year-to-date is down by about 7 to 8%. Tesla is also down negative year-to-date. Did not enjoy the rally as much. Can we anticipate the continuation of this rally, and what are the underlying risks present in the US market?
Yes, thank you, Kim, for hosting this call, and thank you for all for listening in. On the US market, yes, it has done very well year to date and also last year. And will it continue is a very big question. We are also thinking very hard about it. So on our side, we think that the US rally is predicated on a few things, which has happened over the course of the past 2 years. Firstly, there is the strong economic growth. If you look at the nominal US GDP, it is still growing at 5 to 6% year on year. And this growth is coming from robust government spending, which is, you would see that their fiscal deficit, budget fiscal deficit is running at 6 to 7% of GDP. So the US government is spending liberally on a few things, such as to rebase the manufacturing of computer chips into their country, spending on renewable energy, also on continuous social programs such as healthcare and unemployment benefits, and of course defense spending, because there are 2 wars ongoing in Ukraine and Israel. So the US government is spending very strongly. That's how the US is rallying. The second thing is Fed is actually coming out to be supportive by saying that they are willing to cut rates this year because they are seeing that inflation has come down from roughly 8% levels in 2022 to 3% levels today. So that is the second factor that we are seeing. The third one is that currently there is very strong investments into AI in terms of whether it be software like ChatGPT, Gemini from Google, or infrastructure, which is the AI servers. So we see that all these three factors actually are continuing. So even though market is running very strong, valuations are high, actually these are we are still positive on the market because economic growth continues to be strong, Fed is supportive, and there is still a lot of investments into AI.
All right, Edwin, we hear you on the still resilient economic growth in the US coupled with the demand on the AI. What do you think, Pan Nazifa?
Okay, I think we are also in line with Edwin. Now let's look the performance of the Magnificent Seven stocks in 2024 against the broader indices. As of yesterday, S&P 500 is up 9.1% year to date, while the Nasdaq Composite has gained 8.7%. Out of the seven stocks of the Magnificent Seven, Apple and Tesla are down by 9% and 28% year to date respectively, while Alphabet only up 8.7%, same with the Nasdaq Composite. We see Microsoft and Amazon are decently up and outperform the index by 14 and 19% respectively. And Nvidia remains the leader with return of 93% so far as of yesterday, and Meta at second spot with 43% return. This conclude that 2024 saw the rush toward AI-led companies and their stock prices rallied. It seems that the five companies in the Magnificent Seven have been rewarded for efficiently utilizing AI for their earning growth, while Apple and Tesla have been penalized for not doing so. Now, how about the continuation of rally? Looking at 2024, there are little to believe tech outperformance will reverse. The release of user-friendly chatbots found an immediate audience. Within the 2 months of its official launch, ChatGPT reached 100 million monthly active users, making it the fastest growing consumer application in history. The popularity of the OpenAI design chatbot spurred other notable rivals. Google come out with their Bard and Geographic Designer Midjourney. We see AI systems are now capable of producing digital art design, college level essays, and software codings, all in just a matter of seconds. So, in addition to that, Bloomberg Intelligence predict generative AI sales to reach 1.3 trillion over the next decade from the market size of 40 billion in 2022. This representing a compounded CAGR of 42%, with rising demand for AI product adding 280 billion in new software revenues. So these numbers are hard to ignore. With that, we see companies harnessing AI would not only establish a competitive advantage for themselves, but would also unlock substantial client and shareholders' values, which enriching the entire business ecosystem. So, we are in line with Edwin. Looking ahead, several factors could potentially support the continuation of this market rally. Again, positive economic indicators such as low unemployment rate, robust customer spending, and also strong corporate earnings could contribute to further market gains. Additionally, Fed accommodative monetary policy characterized by their low interest rates and quantitative easing has historically been supportive for equity markets.
Inflation in the US if they want to import stuff and there's a lot of tariff. And it would make Fed to consider raising rates again. So this is a real risk that we need to consider. However, we do think that his views, Donald Trump's views, will be moderated. So it would not be as bad as he states it out to be. Another thing is on geopolitics, it will be even more uncertain because Trump has isolationist streak. So there might be less support for Ukraine. Ukraine is a major producer for agricultural products like wheat, corn, sunflower, rapeseed. So all these are very crucial products to prevent food price inflation. And if, let's say, Ukraine falls, is affected by the war and Russia, takes over, then we have a lot of more risk on food inflation. So, and overall, if US doesn't take charge of matters globally, there is also more equity risk premium in the market that we have to impute. So the share prices, equity share prices might be more subdued than otherwise. Yeah, that's what I can say for now. If you have any further questions, then we can go ahead with that.
Yeah. Thank you, Edwin. What do you think, Nazifa? Do you share the same view with Edwin or otherwise?
Quite similar. Okay, latest poll shows Trump beating Biden of 46% versus 45%. And when I screen through the polls, actually men skewed towards Trump as compared to women to Biden. And that's not matters most. The most important is historically the S&P 500 was down in 4 of the 16 presidential election years since 1952. The only down years were in 1960, 2000, 2008 and 1952 if I'm not mistaken, when both parties offered new presidential candidates. So given that this year, I think the candidates most of us known already, President Joe Biden and Donald Trump is just two candidates that or I think everyone knows about them. And okay, if a democratic victory, for instance, might be perceived as negative for certain industries such as healthcare, energy and financial due to potential regulatory changes and higher taxes. On the other hand, we foresee if Republican win could be seen as a more favorable for sectors like energy, defense and financials, given the party's generally pro-business stance and lower tax policies. Furthermore, these candidates' stance on trade policies, particularly with major trading partners like China, could also impact global markets and international trade dynamics.
Looks like on average, during the year of the presidential election, January is positive for the market. And in fact, just now Nazifa also pointed out that out of the past couple of presidential elections, there are only 4 years that we see negative return. But of course, I think whatever that is happened in the past may not represent the future performance. And speaking on election, Edwin, 2024 is the biggest election year in history. Indonesia's election took place in February. India will hold their general election sometime before June. How do you foresee these events influencing the market? And do you have an optimistic view in these two markets?
Right. Thanks, Kim. So I'm glad you asked these questions. I covered these two markets. So for both of them are having elections, and in both of them, the incumbent is very strong. Okay, Indonesia, I'll explain a bit. But in India, let's start with India. So in India, Modi is has been the Prime Minister, and he is expected to come back in a big way to win big in the elections. The elections will be from April to June in that period. And latest poll show them his party BJP winning 64% of the parliament seats. So in the previous elections, he won 56%. So expecting him to win even bigger majority. And Modi's party has been pretty strong on the infrastructure and manufacturing agenda. They're pushing really hard on these two things, focusing on building all kinds of infrastructure like roads, railways, power plant, some renewable energy like solar, wind, and waterworks, and all kinds of things that will benefit the productivity of India. On the manufacturing side, they're pushing for production-linked incentives. They call it the PLI program. You give tax, I would say it's not tax incentive, it's extra incentive, like extra money for you to invest in capex for manufacturing facilities. So it can be in various sectors like semiconductor, smartphones, laptop, pharmaceutical, auto. They have prepared these incentives for all these sectors. So if he comes back, of course, all these programs will continue, and it will be actually quite great for the overall infrastructure of India. So on this market, I'm quite positive. I think it's worth drumming up interest on India in the Malaysian market. This is the strongest growing large economy in the world. It probably can consistently deliver 6 to 7% annual growth, GDP growth in the next 10 years. Part of it is because the infrastructure push will bring a lot of productivity gains. You build an extra bridge and immediately you cut transportation time, you know. Those kind of things really matter for a country with little infrastructure. And I see that the Indians are really motivated to move up the value chain. It's not enough to be just, you know, at the bottom level and earn a bit of margins, but they really want to go into higher end sectors. They are already in the IT services industry, and they are leaders there. Also leaders in generic pharmaceuticals, and in all other areas they are trying to move up, whether it be digital banking, e-commerce, semiconductor, automotive, renewable energy. So they are very, I would say, industrious in that sense. So I do see India as the next China. They have the talent, they have the motivation to do stuff. Their market is huge. They have the international standing, geopolitical backing of the Western countries, and the leadership is strong. So the trend should be good going forward. But in the near term, since all of this makes Indian market more predictable, it also means that the valuations are high. So right now, Nifty, which is the index for India, is trading at 20 times. The peak is 22 times. So there is still some upside, but we do hope for a correction, a small correction, before collecting into further into the market. For Indonesia, so Prabowo has won the presidential elections. He got 58% of the vote. He won with the strong backing of President Jokowi, the incumbent president. And due to this, we expect him to follow Jokowi's economic policies. And indeed, he's giving us good signals that he intends to follow the previous administration's policies. The two key ones will be a new capital. They call it Nusantara. It is in Kalimantan. And the second key policy is mineral downstreaming, meaning that Indonesia is such a wealthy country in minerals. You can say coal, nickel, and some aluminium, tin mining. So they want to increase the value, go up the value chain. Go down the value chain and build more higher value-added stuff. For example, for nickel, they are going to mine it and process it into stainless steel. So we do see Indonesia as a good country to invest in also because we think that they can grow 5 to 6% annually in GDP. And they have really benefited during Jokowi's term from infrastructure build-up, whether it be the toll roads in Trans-Java and Trans-Sumatra, and also the MRT lines in Jakarta. And with Chinese capital and expertise, they are now the largest nickel smelter and stainless steel producers in the world. So our concern would be that they actually need another growth story. Mineral downstreaming might just be not enough of a boost for the market because it is well known, and nickel as a future raw material for EV batteries. There are many other competing chemistries for EV batteries. The big one is LFP. So LFP battery is now more popular, and so nickel might be sidelined for growth in LFP. So we are a bit concerned on that. So we think that Indonesia needs another growth story. However, having said that, the JCI index is actually not expensive at all. It is at 14 times PE, which is lower than the 10-year average of 15 times. So we think that it's a good market to enter, but we would have to be selective on the higher growth names.
Okay,
Yeah.
thank you.
Thank you.
Maybe since you are covering India and Indonesia market, probably we just extend a couple more questions on these two regions. On India, probably just now you mentioned about the valuation is high and you are now waiting for a better entry point to enter, waiting for further correction. But of course, I think last year India market has also done well as well. But this year looks like the performance of India market has been I mean the gains are still there, but of course the pace has been slower than last year. So is it a good time to look at India market now, or probably we still can wait for a better entry point?
Right. So just like 1 or 2 weeks ago, there was a small and mid-cap correction in India, and the small to mid-cap stocks went down by like 10 to 15% on average. We thought that it is the start of a correction, and we wanted to wait for a bit more. Because the small and mid caps in India can be quite expensive. They can be like 30, 40, 50 times PE. So even if it corrects 15%, it may still be at 30 times PE. So we thought that we can wait a bit more, but just within like 1 to 2 weeks, it recovered, let's say, more than half of the drop already. So that is just the state of the Indian market, where you want to be choosy, but you cannot be too choosy in terms of timing. So I would say gradually put in some allocation into India, because everyone can see the long-term trend and everyone is looking at the market very closely and very eager to enter the market. So yeah, it is a good place to put capital in a gradual manner. That is what I would say.
Yeah. Where does the liquidity coming from?
The liquidity, yes.
Yeah,
yes.
support the India market.
Yeah. So actually the liquidity, a lot of it is coming from domestically, meaning local Indians investing in the equity market. So traditionally, they like to invest in property and gold, and probably keep some of the money in cash. And equity allocation is only like 5 to 6%. And then in the recent 2 to 3 years, Indians have been increasingly allocating to equities. So you can imagine, let's say 6% goes to 7%, 8%. There's a lot of room for them to come into the market. And that is really what they have been doing. And we can see local unit trust funds have been doing extremely well, growing easily 20, 30% every year. So there is a lot of domestic liquidity supporting market. At the same time, due to weakness in China, a lot of Asian fund managers or international fund managers are also looking at India as the next market. So it's also a lot of interest there. But every time the foreign loses interest, the domestic comes in to support in a big way. So that's why you may not get a very big chance to enter India in when if you are waiting for attractive valuations, you may not get that chance. That's what I can say.
Maybe before we move on to other Asia Pacific markets, to Nazifa, probably just one last question on Indonesia. Edwin, on Indonesia, noted that usually when foreign investors are coming into Indonesia, investing in Indonesia, that you usually buy banks. So if you are managing a Sharia funds, how do you navigate along these restriction, these challenges, and what kind of opportunities are there in Indonesia that are actually complying with the Sharia requirements?
Okay, yes. The challenge of investing in Indonesia is liquidity is very tight. So if you are managing a big fund, there is only like probably 10 stocks that you can look at on an active basis. And out of the 10 stocks, 4 of them are banks. So like you rightly pointed out, it will be a big challenge for Sharia funds. And outside of that, the banks, it will be only a handful, like Astra International, which is auto distribution company, and Telkom, which is telco company, and a few consumer names. So right now, actually, we are quite cautious on the rest of the names. So from telco to consumer, we are cautious on these names because the mid to low income consumers of Indonesia are not doing very well right now because of high inflation and salary growth has not been great. So there's not much impetus and earnings per share are not growing for these companies in a very healthy way. So I would suggest there are other opportunities, but you have to take risks. For example, Astra International, one of the largest auto companies, is trading very cheap now. But there's a reason for it. That's because EVs are starting to come in. As you can see, BYD has come into Malaysia, Tesla has come into Malaysia. So same thing, BYD is going into Indonesia, so threatening the auto industry. So, but we still like it. So, but you must be cognizant of the risk when you choose this stock. So you have to be selective if you are a Sharia investor. Yeah, so it is limited. You may want to look at other markets if you are a Sharia investor.
All right. So moving on to other Asia Pacific markets, Nazifa, Korea, Taiwan, Japan have actually done well in 2023 and year to date. Do you think we should take profit, or do you believe there's still room for further upside?
The Asia Pacific markets, including Korea, Taiwan, and Japan, have indeed performed well in 2023, and year to date reflecting strong economic fundamentals, robust corporate earnings, and favorable macroeconomic conditions. These markets have benefited from factors such as technological innovation, global supply chain realignment, and improving economic growth prospects, which have driven investors' interest and market valuation higher. And nowadays, I think bullishness about artificial intelligence has lifted tech stocks, creating a ripple effect in Japan, Taiwan, and Korea that shows no sign of abating. With the Fed expected to start cutting interest rates this year, as US inflation comes, investors are more inclined to take risks. When considering whether to take profits or anticipate further upside of these markets, I think investors should take several factors should be taken into account. Firstly is the valuation of the market have risen, and some sectors may be trading at elevated levels, potentially limiting further upside in the near term. I think high valuation could make these markets more to inclined to market corrections or pullbacks, especially if there are any adverse development or unexpected shocks. Secondly, while the economic and earnings growth outlook remain positive of these markets, there are potential headwinds and uncertainties that could impact the market performance, including geopolitical tension, inflationary pressures, and also policy normalization by central banks, which could lead to higher interest rate and tighter liquidity conditions. Um, However, despite this consideration, there are reasons to remain optimistic about the long-term prospect of Korea, Taiwan, and Japan markets. These economies continue to benefit from technological advancements, strong export growth, and also structural reforms aimed at boosting productivity and competitiveness. Moreover, ongoing global supply chain realignment and the shift towards uh, regionalization could further support these market growth trajectories. So, while the Asia Pac markets of Korea, Taiwan, and Japan have performed well and offer attractive long-term growth prospects, I think investors should mindful of the elevated valuation and potential risks in the near term. I would suggest that it may be prudent to consider taking partial profits or rebalancing your portfolios to lock in gains and manage risk. Um, However, given the positive economic fundamentals, technological innovation and structural growth stories of these markets, there are still be room for further upside for investors with a longer term investment horizon. I think as always, it is essential to conduct through research, diversify portfolios, and consult with your financial advisors to make informed investment decision tailored um, uh, a- uh, along with your risk tolerance and investment objective.
But so looks like for those investors that actually uh, you know benefited from the rising markets in Korea, Taiwan, and Japan, it's not a bad idea to actually take some profit off the table. But what about China? Should we actually switch some of the funds that we actually raise from selling Korea, Taiwan, Japan to China? What do you think, Nazifa? Is it a good time to position? And what are the catalysts or challenges that investors should be aware?
The CSI 300 index and Hang Seng index experienced challenging year in 2023. They lag behind other global and regional markets. However, both indices have shown signs of recovery year to date, which prompt investors to reassess their investment strategies and also consider whether now is a good time to position themselves in these markets. Several catalysts have contributed to the recent uptick on these indices. First and foremost is the Chinese government has implemented range of monetary and fiscal policies aimed at supporting economic growth. These policies include targeted stimulus measures, tax cut, and also regulatory reform designed to improve the overall business environment and also to stimulate economic activity. Additionally, China's economy has been gradually recovering from the impact of COVID-19 pandemic, driven by resilient domestic demand, strong export growth, and also a rebound in their industrial production. Moreover, after underperforming in 2023, these Chinese equities and Hong Kong listed stocks may now offer more attractive valuations compared to other regional markets, which presenting potential buying opportunities for investors seeking value. And we see the implementation by the government have led the latest numbers February saw the best gain in Chinese stocks since the post-pandemic reopening and bolstering investors' fragile confidence. With investors confident of further upside as they anticipate some policy catalysts, among others, as I mentioned, They started relaxing stringent COVID-19 curbs, and the central bank delivered the biggest cut on record, the 5-year loan prime rate in February to support their property market after bigger than expected reduction in the reserve requirement ratio for banks. And the implementation saw CSI 300 index tracking the biggest stocks listed in Shanghai and Shenzhen climb 9.3% in February alone. And looking at zooming into the small cap stock, the CSI 1000 index also advanced close to 12%, the most since July 2020. And I think this is another option for investors to look at, because after rallying so much in other countries, it is fair for you to look at other countries which still undervalued, I would say, compared to those already give return about double digit year to date.
Okay, thank you, Puan Nazifa. Edwin, since we have covered India and Indonesia, within Asia Pacific markets, which markets do you think there are still potential for investors to consider?
Like Puan Nazifa mentioned, a few markets actually went up by a lot. In Asia Pacific, it is Taiwan, India, and Korea to some extent. Okay. Which markets can still do well? I think Taiwan is not cheap already. So in fact, Taiwan's PE is near its all-time high already. So I would say that be cautious on Taiwan. It is following the path of Nasdaq. There may be a bit more upside, but downside is also there. You must think about it. So because of that, actually, I think Korea looks a lot more attractive. And so let me see. Korea right now, the PE is for the market is at 11 times compared to the peak of 13 times. But 11 times on an absolute basis is actually, very okay. Of course, there are a lot of fundamental reasons why it's cheap, because corporate governance has not been great for a very long time, because of the structure of the shareholdings of Korean companies. But then in Korea, we do see two engines of growth. One of them is there will be a lot of demand for memory chips for the AI servers that are going to be built. And this will benefit stocks like Samsung Electronics and SK Hynix, which are pretty much the top two stocks in Korea. Second catalyst is there is a value up program that the government is trying to push. They are trying to mimic the Japan corporate governance program, and they want to push up the value of the names that are under price to book of under 1 times. And these are names in banking and auto sectors especially, and on the overall there are a lot of conglomerates in Korea. So people are half believing and half skeptical on this value up program because they tried this before last year with the banks and didn't really go anywhere back then. But now the authorities, the financial regulators, and the politicians seem to be very keen on pushing this, especially it's also an election year in Korea. So we do see this as an interesting catalyst, and certain banks do now try to pay up more dividend, so dividend yield is higher, and I think this is a continuing trend that would benefit Korea this year. So yeah, Korea is a very interesting market in my view.
Okay, thank you, Edwin. Move on to Malaysia, Puan Nazifa. We see our PM, Anwar Ibrahim, has been actively engaging leaders from China, US, Singapore, Japan, Korea, and recently Germany. We have secured, I think, 40 over billion of or 70 billion over investment commitments from them, and also introduce initiatives like NETR, NIMP, Trump Malaysia Plan, midterm review, and so on. Looking ahead, what's the country's outlook in terms of the opportunities and challenges, and what strategies could investors adopt to capitalize on these opportunities?
Okay. Malaysia's recent diplomatic engagement, spearheaded by our PM, Anwar Ibrahim, with key global players such as China, US, we see several other countries as well, signify the country's proactive efforts to strengthen international ties and also foster economic collaboration. We see these diplomatic efforts coupled with initiatives like the NETR and IMP, 12 Malaysia Plan, reflects Malaysia's commitment to drive economic growth, enhancing competitiveness and also attracting foreign investment. On the opportunity front, the enhanced diplomatic relations and the introduction of investor-friendly policies are expected to attract more FDI into Malaysia. Sectors such as manufacturing, technology and services could particularly benefit from increased FDI inflows, leading to job creation, technology transfer and economic diversification. The continued investment in infra projects under the 12 MP could stimulate economic activity and create opportunities in construction, transportation and also logistic sectors. Additionally, the focus on entrepreneurship and innovation through initiatives like NETR could spur growth in the digital economy, benefiting sectors such as e-commerce, fintech and also cyber security. So all in all, we are positive on Malaysia. 2024 should be a better year for Malaysia on several fronts. It will be a year of execution of the macro blueprints launched in 2023, as well as a year of delivery, especially in fiscal reforms to bring the country's balance sheet back on stronger footing. We forecast GDP growth to be between 4 to 5%, underpinned by resilient consumer spending, sustained private and infra investment momentum, plus recoveries in trade-related services and manufacturing industries, namely tourism and electronics. For equities, the tail end of global monetary policy tightening, while stable domestic interest rate policy outlook, improvement of ringgit, economic transformation via the NETR and NIMP, rising FDI momentum and better corporate earnings outlook are among the key catalysts. Also, not to forget is our valuation. Valuation wise, the FM KCI is currently traded at a discount of 15 times PE against its historical of 16 to 17 times. Points more upside for the market. In terms of portfolio positioning, we are cautiously optimistic and view that any market pullbacks offer windows and opportunities for portfolio positioning. And then, however, several challenges might remain as investors should be mindful of. Global economic uncertainties, including inflationary pressures and supply chain disruptions, could impact Malaysia's export-oriented industries and also overall economic growth. Political uncertainties and potential policy shift could create volatility and hinder long-term planning for businesses and investors. We hope that this will not happen, given that our current Agong already mentioned that he will give until this term to the current government, to the Madani government. And then on the regulatory changes and compliance requirement may pose challenges for businesses as well, particularly in sectors facing increased government scrutiny and intervention. Considering that macro headwinds with confluence of changing economic outlook, we think it is imperative to have defensive and also prudent approach in navigating the uncertainties. Our strategy going forward is more on astute picks and active stock allocation to capitalize on market opportunity. And I would say that buying on weakness with core holdings skewed towards defensive and high yielding stocks to take advantage on rotational investment themes, and also focus on recovery and structural growth themes, like construction, healthcare, property, and industrial, and also materials. And not to forget, for structural growth streams, we also like sectors like technology and renewable energy.
Okay, thank you, Nasiba. We hear you on there are pockets of investment opportunities in sectors such as, like you mentioned, property, construction, utilities, healthcare, tech. Earlier on, you also mentioned about transport and logistics, e-commerce, and cybersecurity. And also, but one should also be monitoring on the risks and challenges as well. I think we are quite susceptible to any global markets correction. But one good thing about Malaysian market, like what Puan Nazifa mentioned earlier, is political stability and also our cheap valuation. What do you think, Edwin? Do you share the same perspective with Puan Nazifa?
Yeah, so at the start of every year, we will look around ASEAN. We will try to evaluate which countries have story. We want to see what has changed, what is the catalyst for each country. Interestingly, this year Malaysia looks a bit more interesting than other countries. For the countries that we cover, so for Thailand, it looks to be a bit slow because tourism hasn't fully recovered and the population is a low growth population.
Yeah, and I think they also delay the cash aids to the Thai population.
Yes,
Yeah.
so there's some execution issues there.
Mm.
Another thing, if you look at Indonesia, sure, they have an election and, Jokowi administration, probably his influence continues with Prabowo. It is at best a continuation. We want something new. We want growth. Yes, Indonesia is perpetually a high growth economy. I mean, due to its low base and high population. So I guess it can deliver 5 to 6% annual GDP growth. So it's always interesting on our radar. So I would say Indonesia, positive. It's not a neutral. Singapore, we don't really see anything that exciting, new stories. Yeah. So Malaysia actually starts to stand out in this environment. One thing is, well, we have a new government, and it seems like they are trying to getting some political stability. And after they get this political stability, they are pushing for programs. It can be in Johor, it can be data centers, more construction projects, MRTs coming up. So these are new stories to focus on. So for me, I'm more like a foreign investor than a local investor because I look at Asia Pacific markets, and Malaysia is only like 1 to 2% of my portfolio. So I will see, okay, what's interesting. And this year, glad to say that Malaysia will take up a bigger part of my portfolio because it looks more exciting than the rest of the region. Yeah. If you say what is exciting, I consulted with my Malaysian colleagues because they know more about this. They like the property sectors, especially those that still got upside because it has run quite a bit. So we'll look for property stocks which have lower price to book values. Healthcare, because there are stocks like KPJ have management changes and looks more dynamic. Maybe some glove stories because supply and demand is starting to improve. And also oil and gas, because, well, Petronas is giving up more contracts and oil prices are looking better because demand is better this year. Yeah, so those are the sectors that we are looking at. The large caps, have run quite a bit. So, as I said, I'm looking at this from a foreigner perspective. Even if I'm a foreigner, if I want to enter Malaysia, do I look at large caps? Well, they are fairly valued. They need to see earnings to execute. They need to surprise positively on earnings. Can they do that? Well, so there is a bit of thinking over there, so a bit of holding back, So we would look for something more interesting and hasn't been fully priced in. So I would say mid to small caps would be more of the focus.
Before we end the session, probably we give Tuan Nazifa and Mr. Edwin a chance to showcase some of the top, recommended funds that actually managed by you guys that you think could help investors navigate along this challenging but yet interesting market. Nazifa, over to you.
Sorry. Okay, thank you for the opportunity for us to promote our fund. As mentioned earlier, in terms of the rally in the global market currently, especially to some of the countries, we I would suggest that especially in the US market on the Magnificent Seven, on my advice to for the investors to take some profit and trimming holdings in the Magnificent Seven, which could be prudent move at this stage in the momentum cycle. Another option to stay in the equity market is to shift into to consider diversifying the portfolios by including equal weight index exposure. Because this strategy has the potential to minimize downside risk in the event of significant momentum reversal in the big cap while still participating as market continue to move up. So on this note, BIMB Investment Management do offer a few global equity weight funds to provide investors with risk control when reversals happen. So we have a few RBS funds, which technically is AI driven funds. And please contact our sales rep for details because we have a few funds having this type to offer to our investors.
As I mentioned, our house as a whole, we have been positive on Malaysia since the beginning of the year. Year to date, Malaysia probably done like 6% return. So when asked my Malaysian colleagues, we ask them, what more can you do? What more can you give us? And then they say they are still positive. They think there's another 3 to 4%. They don't want to give us too much false hope. It's already done 6-7%. So there is still some upside over there. And they will push the funds accordingly. So on the Malaysia side, I would recommend our AHAM Select Opportunity Fund. So Select Opportunity Fund, that's the Malaysia side. And from the Asia side, which I'm currently helping to look at also, so there is the Select Asia Opportunity Fund. So there's an extra Asia word there. So we look at overall Asia ex Japan, and our main markets are China, Taiwan, Korea, India, these 4 main markets, and then we invest a bit in Indonesia and Malaysia as well. And we try to rotate between whichever markets are looking interesting. As I mentioned, we like Korea right now and Malaysia. And then we'll be a bit cautious on India and Taiwan. So that's what we are doing. So you can check it out or contact our sales rep.
All right. Okay. Thank you, Mr. Edwin and Puan Nazifa for their insightful sharing. That's all for today. Stay tuned for our next Phillip Roundtable. This update is brought to you by Phillip Capital, your partner in finance. Thank you.